Thank you, Paul, and thank you for organizing this most interesting discussion.
I don't think you can see this.
As Paul has said, last year and early this year, we heard all kinds of nice speeches from both the Treasury and the Fed and others about what good shape the banking system was in. Of course, the shadow banks, so-called, were very much to be feared and had to be regulated more. But the commercial banks were in great shape, and that was thanks to the Dodd-Frank Act and the regulation which had followed it that we could congratulate ourselves for this wonderful shape. Well, since then, needless to say, as we have been discussing, we've had the failure of multiple banks, emergency declarations that these failing banks were systemically important, that is to say that the system of banking was at risk. We've had bailing out wealthy depositors in the failing banks. Those depositors, by the way, who should have taken a haircut on their risky investments that they made. I mean, for the folly of maintaining hundreds of millions in some cases, or even billions of dollars in one medium-sized bank. Quite an amazing risk management decision on the part of those depositors, but of course they were bailed out. And then, as Paul and Bill have both said, we have the highly interesting situation of the Fed lending very large amounts to the FDIC, well, to the receiverships of the FDIC directly, something we think is unprecedented. And then all the time with this going on, statements from responsible government officials that the banking system, don't worry about these failures and these emergency declarations and so on. The banking system is sound and resilient, and you can have confidence into it. But it turns out that not only the failed banks, but many banks across the country had followed the Pied Piper of the Federal Reserve and its lower for longer predictions, statements, and practice to invest long in long-term fixed-rate assets and borrow short, thereby creating lots of both interest rate risk and liquidity risk in the banking system. As others have said, a classic banking risk, a classic banking mistake, and it faces the following problem. That when it comes to deposit runs, it's often said, well, we have these irrational fears. But in fact, runs are highly rational from the viewpoint of the depositor. Keeping your money in the questionable bank, which you can't really know what its assets are worth or what's going on in it, has no upside and vast downside. The best you can ever hope for is to get your money back, plus a little interest. The worst you can fear are gigantic losses. So it's highly rational to run. And every banking system has to be structured with the thought that runs are rational from the viewpoint of the depositors, and therefore we have to expect them in certain circumstances. On top of all this, we find out the banking system has, again, a large exposure to commercial real estate, which is troubled and known to be risky. Once again, I have a quote here, one of my favorites. Quote, the unfavorable conditions in banking were greatly aggravated by the collapse of unwise speculation in real estate. Unquote. That's from the report of the Comptroller of the Currency in 1891, and a little has changed since then. Now, on interest rate risk, one academic and plausible estimate is that the mark-to-market loss of the entire banking system, including both securities and loans, that is to say, your market value losses on fixed-rate loans are every bit as relevant and as important as the losses on securities. And if we take both of those into account, according to this study, the banking system has a mark-to-market loss of about $2 trillion on its fixed-rate securities and loans, $2 trillion. What's the capital of the banking system? Well, it's about $2.2 trillion, but of that 2.2, 400 billion are intangible assets, goodwill and whatnot. So the tangible capital of the banking system is a number like 1.8 trillion, and the mark-to-market loss may be something like $2 trillion. That would suggest to you that you have an entire banking system with, taken on average across the whole system, something approaching zero capital. That, of course, has large variation among the 4,000 and some banks, but that would be the overall situation. Now, what does this mark-to-market loss mean? May I recommend to you a paper by our excellent chairman, Paul Kupiec, and me, called How Unrealized Losses Turn into Real Losses. And the way unrealized losses turn into real losses in leveraged financial institutions who have their fixed rate long-term assets funded with short-term floating rate liabilities is the cost of the liabilities goes up, and you turn the unrealized loss on the securities into realized cash losses because you're making your old, let's say, 2% return on your fixed rate investments, and it's now costing you 5% to carry them, and you're losing a lot of money that way. Now, the big question in the banking system then becomes, how resistant is it to the cost of its deposits rising up to market levels, which are 5% or so short-term interest rates, in order to carry the large amount of fixed-rate loans and fixed-rate securities on which this $2 trillion or so loss exists. How much is that interest cost actually going to rise? In other words, the banking question becomes, how much can you continue to cheat the savers in order to prop up the banks as the unrealized losses turn into greater interest expense? And that's what we're going to observe here going forward, this contest between the inexorable rise in the funding cost and the hope that you can continue to cheat the savers and keep the deposit cost down. This puts the banking supervisors who are in favor of bank safety on the side of cheating the savers, of course, as it always has put them on that side historically. Now, this puts me in mind of two great quotes from Paul Volcker. The first is, as some of you may have heard before, is this: about every 10 years we have the greatest financial crisis in 50 years, said Volcker. He was so right, and we're in it again. Now, I think of the current crisis actually as still the ongoing crisis of 2020. We start off in 2020, the COVID crisis, the financial panic, the sharp economic contraction, the vast expansion of money printing and government expenses, the following bubble markets in everything, or the everything bubble, the runaway inflation, the correction with rising interest rates, the deflation of the bubble in the markets of 2022, and now the banking problems of 2023. I think of that as all one big crisis we're still in the aftermath of. And here we are. Well, the last crisis bottomed in 2009, so it's more or less 10 years, or about every 10 years, as Paul Volcker said. Now, the other Volcker quote I want to mention is, "There are no new problems in banking, only new people." It is to say, the new generations get to relive the things that the older ones already did. And this was, on Volcker's part, quite a clever way of talking about the recurrence of banking crises. But here's the question: why do these crises keep recurring when we have such improved regulation? Like, say, the Dodd-Frank Act and the tens of thousands of pages of implementing regulations. Well, this brings me to a quote from the banking and central banking scholar Bernard Schull, who insightfully wrote in 1993, Comprehensive banking reform, traditionally including augmented and improved supervision, has typically evoked a transcendent and, in retrospect, unwarranted optimism. In his day, Scholl wrote, confronting the S&L disaster with yet another comprehensive reform, the Secretary of the Treasury proclaimed 2 watchwords guided us as we undertook to solve this problem: never again. Well, that was the reform of 1989, and then the banking reforms of 1991. But after that, of course, we got right into, in something over 10 years later, another massive crisis, as we all know. The crisis happened again. Anyway, in spite of the transcendent optimism about the comprehensive regulatory reform, after the 2007-9 crisis, and of course, the crisis in Europe went on to 2012, but here in 2010, comprehensive reform was once again debated, and the political reaction was the Dodd-Frank Act as the inevitable follow-on to every financial crisis. But here we are once again saying, well, now with all this, why didn't this work? And it seems to me that we're up against this fundamental reality of the politics of banking and finance. And Charlie mentioned politics, but all finance is political. There is no finance that isn't political and politically influenced. There's probably not much of importance in politics that isn't financial as well. As we look at this, however, no matter how we organize any government activity, it seems to me, as circumstances change, it will over time have to be reorganized. The perfect answer, unfortunately, does not exist. And whenever we try to engineer and control human behavior, which is what financial regulation is, trying to engineer and control human behavior, those attempts at control themselves induce unexpected adaptations and reactions in markets and also in the behavior of the regulators and politicians themselves. Hence, as we observe historically, every reform requires another reform to address the unexpected results of the prior reform, and so on ad infinitum. Bernard Scholl is also the author of Scholl's Paradox, and since we're talking about the Fed and its role as leader of the financial system into the current interest rate risk problems and liquidity problems, Scholl's paradox is no matter how many blunders the Fed makes or how big they are, it always becomes more powerful and more prestigious. It seems to me this paradox is true, and we might well be living through another case of it. Now, another way of talking about the evolution of the last reform and how it turns into the next crisis, the next reform. By the way, may I recommend a great paper by Arnold Kling called Not What They Intended, which is how the reforms of the 1990s created the collapse of the 2000s, as a wonderful example of this. But another way of saying this is when we talk about the banking system does not mean the banks only. The banking system is the interacting combination of the banks and the central bank, in our case, the Federal Reserve, and the regulators, the controller of the currency, the deposit insurers, and the politicians. All of that together as one interacting system is the banking system. And we saw this with the Fed's interaction with the banks and their behavior as the Fed set up and enforced near zero interest rates, near unexpectedly extremely low interest rates for over 13 years. 13 years is plenty of time for financial actors to build up the expectation that this will continue. even though you might argue that the longer it goes on, the greater is the probability it's going to reverse in a dramatic way. Markets often act that way, but nonetheless, the assumptions get built up, especially when the Fed was not only keeping short-term rates low, but long-term rates low through its own security purchases and the building of its own quite remarkable up to $8.9 trillion balance sheet. So the Fed was by far the biggest bank in the country at $8.9 trillion. It was also the biggest savings and loan, because inside the Federal Reserve, as they were buying not only bonds but mortgage-backed securities, was a mortgage portfolio of $2.6 trillion of long-term fixed-rate mortgages, funded short, funded with floating rate liabilities, making it far and away the biggest S&L, not only in the country, but in all of history. And now, as the unrealized losses on that portfolio are turning into real losses through increasing interest expense, the Fed is earning more or less 2% on its mortgages, more or less 2% on its long-term treasuries, which, of course, the mortgages just got a lot longer with the increasing interest rate risk through negative convexity, but the treasuries are also very long. They own a ton of treasuries of more than 10-year remaining maturity. So they're making about 2%. They're financing those at 5%. Well, if your income is 2% and your cost is 5%, it's hard to make money that way for a bank or for the Federal Reserve. So the Fed's own balance sheet, as Paul pointed out, was jammed with gigantic interest rate risk. And so one might not unreasonably ask, how could the Fed criticize banks like Silicon Valley Bank for doing exactly the same thing that the Fed itself was and is doing? As I say, a question one might not unreasonably ask. Now, of course, if you had been confident in an interest rate forecast that short-term interest rates would stay low for very long periods of time, that kind of balance sheet would have been a good bet. You would have continued to make money. You could have had 2% income and, say, a 0.5% interest expense. So let us ask what were the Fed's own interest rate forecasts as it was accumulating this massive interest rate risk and portfolio? Well, I want to look at the Federal Open Market Committee's interest rate forecast for June 2021, done in June 2021, the forecast for the end of the year 2022. Anybody know what the Open Market Committee's Fed funds forecast for the end of 2022 was in June 21? The median forecast was 25 basis points. Of the members submitting estimates, the highest rate was 0.75%. Well, how about for 2023 at that same meeting? What did they think interest rates of the Fed funds target would be by the end of 2023? The median forecast was 75 basis points. The highest submitted estimate was 1.75%. Well, obviously, had those forecasts been right, the position of Silicon Valley Bank or the banking system as a whole or the Fed itself would still have been profitable. So I can't read these forecasts without thinking of that famous, that deservedly famous poem, Casey at the Bat. And just like Casey, as far as this interest rate forecasting goes, the mighty Fed struck out. And the result is that its aggregate operating losses, the Federal Reserve itself, since last September are $54 billion. Now, even more fundamental than this, because we're talking here about the fundamental causes for the banking system, and I think even more than this is this underlying unresolved conflict. And it is this, that people all over the world, in this country and all over the world, long and want their bank deposits to be risk-free. And governments want to make these deposits risk-free. And they attempt to satisfy this longing for risk-free deposit insurance by creating deposit insurance schemes and intensive regulation, and for bailing out depositors of failed banks, and for striving constantly to promote confidence in the banking system. We're still seeing that now with announcements that the banks are strong and resilient. But the fundamental problem is that these deposits are financing businesses which are fundamentally highly risky. How do you take the fundamentally risky business of lending money and hoping you're going to get it back? I learned long ago this saying from an old banker: lending money is the only business in the world that when you have made the sale, you give the customer the money, hoping to get it back. So we have a fundamentally risky business, and we're trying to finance it with risk-less liabilities. You know it can't really work over time. It's a fundamental, deep conflict inside the politics of banking and banking systems. So we get, every 10 years or so, a great crisis, and then we get 4 strategies from the government to cope with them. I'll just tell you briefly. The first is the first is saying everything is okay and trying to maintain the confidence. When it's clear that's not true, the second is to mandate delay in recognizing losses. That always happens. The third strategy is expanding credit from the central bank and the government. But no matter how much credit you extend, if you're broke, you're still broke, no matter how much more you can borrow. And so the last is moving to making equity investments in banks. Charlie mentioned the Reconstruction Finance Corporation. And of course, we had TARP. And we go through this because we're facing this underlying conflict. Can we solve this underlying conflict? I've always been intrigued by the old idea that you can solve it if you're willing to separate money from credit and to create some deposits which are actually money, which are actually backed or collateralized by extremely low-risk assets, and other deposits which are not money, they're only credit, and they're fully at risk. Could you really do it? Well, maybe. Would it work? Maybe. It might be worth a try. We'll see as our banking evolution goes on. But I think for sure we're headed to debates about how we can ensure that banking problems never happen again, but that at the deepest level, these debates and the problems we're experiencing reflect this deep underlying problem of trying to create a risk-free financing for what is in fact a risky business. And I will end with this story. When I was younger and I was a senior vice president of a bank, I used to give talks to the trainees, and I would say this, it was true in those days: you will have noticed that around here we all wear dark suits and white shirts and conservative ties, and we exist in wood-paneled offices of magnificent buildings with pillars and marble. Why is that? Of course, they had no answer. So I would tell them the answer is because what we're actually doing is so risky, we have to look conservative.